The
One
stream.
second, I'll refresh your super user.
Ah, check if the stream is coming through. Check if both the videos are coming through all right. If both are coming all right, then we'll kick it off. Yeah, kick it off. Kick it off. So I turned 40 yesterday.
Oh, nice.
Yes, I'm now in my 40s, sweet 40s.
So, how does it feel like entering your 40s officially?
I it doesn't feel any difference. It's just like another rotation of Earth on its axis.
Mm-hmm.
But yeah, more what is it? More responsibility to be credible.
Indeed.
Yes, or maybe incredible as one chooses to be. Chalo, dekho, is our stream working? Then we'll start.
Yes, yes, everything is perfect.
Stream is working.
Yeah,
Voice is
yeah,
coming through. Screen is coming through.
yeah.
Both our videos are coming through. All is good, na?
Yes, yes, yes.
Perfect. Chalo. So, I'll first share your slide, your
Excel sheet.
your Excel sheet here, and I actually you did some work on the IRR with processing fees actually, so you could see a positive NPV and IRR.
Yeah, yeah.
So why don't you take us through this? And actually you closed it by 36th month as well. So you have done both the simulation and you have used couple of formulae as well, right? So why don't we take a look at what you have done? Hmm?
Yeah, yeah, yeah.
Walk us
So,
through.
yeah, sure.
All yours.
Mm, just a second.
Sure, no problem. And whenever you tell us something, do tell us the cell number as well so that people who are watching can know which cell, or just select that cell and highlight with a particular color so that people will know which cell they have to look at.
Sure, sure, sure. So,
So I'm sharing on Gmeet also that tab. Can you see it on Gmeet?
one second. Yes, yes,
हाँ
yes, yes, yes.
ठीक है. So I'm sharing it on Gmeet also, so you will also know what I'm sharing. This is the same thing. It's going to stream as well. Chalo, tell me.
So, what I've done is this basically.
Hmm.
We are lending out 1,000 rupees, and since I could not get the rupees, it's just pounds here.
Hmm.
The assumption is that at the 0th month, when I'm giving my, when I'm disbursing my loan of 1 crore, what I'm doing is I'm charging a processing fee of 2%,
Hmm.
and I'm charging a documentation fee of 25,000 INR,
Hmm.
and I'm also charging a security deposit, which would be 3 months worth of rent,
Hmm.
which would be non-refundable. Again, this is just an assumption.
Huh.
There's no logical basis for keeping it non-refundable. This is just mathematically just to simulate everything I've done this.
Hmm. So
So
usually
the
bank can also do is that, sorry. So what bank can also do is that bank can underwrite the risk. One is the hedging, the kind of instrument by writing an instrument which hedges the risk out of for this kind of a line of credit that bank is extending. Suppose Bajaj Capital is extending this line of credit to Apollo Tires. What Bajaj Capital can do is to write a specific instrument which hedges the risk in case Apollo Tires defaults. That's number one. Second is Bajaj Capital can simply buy an insurance, which pays them 1 crore in case of Apollo Tires default. Such insurances are very rare in commercial lending, but still, instead of hedging, they can also buy. So that money can go towards paying the premium of insurance of that line of credit in case of default. So that it's completely
and
secured.
what about the instruments thing? What exact instruments would they purchase
So if
apart from the
suppose,
usual?
if you are suppose writing a loan of 1 CR, and if you are a financial company and you expect your risk to be hedged, you could then ensure that you have either raised, you actually sell some kind of debentures or some kind of bond papers or something, so that people know what's, let's say, so that you ensure that the risk of borrower's default is inbuilt into a put where you get at least 1 CR back by selling a financial instrument in the market, a kind of a derivative instrument. So you write a put of 1 CR value, so that whenever they default, and they these people can put that kind of money, they can exercise the strike at that strike price. They can exercise the put option and get 1 CR and be even Stevens. So that put will be purchased by someone who is betting that uh, that Apollo will do much better. So if those options are issued by Bajaj Capital, usually very rarely issued, but if they are issued, then the options will look like, suppose I have given 1 CR loan and I issue a put of 1 CR, so that I always get my money back, just to have a covered call. So the benefit here is, if they repay back and they pay back some extra and some extra money, so others get that kind of upside. I only get my 1 CR back if the things go south. If things go north, the upside is unlimited. So usually the people do not keep an upside unlimited. They also write a call of certain value, so that the put and call balance each other. So that if they make lots of money, I also make some money. I don't pay everything to the market. That kind of a hedging can be done if someone writes a risk. But the easiest way to hedge this risk is to get some kind of a artificial insurance situation where I get that kind of money back.
I see.
Yeah, but the more difficult part is to make a portfolio of such kind of borrowers and have a risk premium and ensure that the risk premium matches the probability of default, loss given default. The entire Basel 3 norms comes in Basel 3, or capital adequacy norms, those come into picture. But those are many ways of hedging the risk of inter-party default situation. So that's where that money can go into, in terms of risk management practices and risk management activities. One is the servicing fee and the fees for the executives and the salesmen, and the executive who are doing the due diligence and everything else, because the due diligence will also be done. They need to be paid. So it has to come from this deal only. So that's the margin. I was looking at Morgan Stanley's. I can take the name, na? I can take the name of a random. Uh, that's fine with you, right?
Yeah, sure, sure.
Yes, I was looking at Morgan Stanley's deal desk publications, and they've written a lot of publications about what they issued debt to, how they issued debt to. So they mention that this is the due diligence which they are very proud of. So then they have showed this kind of thing that they are doing. So those are the places where you can use all the extra money: risk management, due diligence, and all the other activities related to debt.
Right.
Hmm.
So,
Next.
and so what is this put thing that we're talking? I'm assuming this is about futures and options. I haven't covered this before.
I will cover it in the coming sessions. Don't worry. Those
Sure,
are
sure, sure.
those are financial instruments. So call is an option to buy, and put is an option to sell, and there's something called as put call parity. So there's an entire formula: C plus K e to power minus R delta T is equal to P plus S naught, which is put and the strike price. So put calls and puts are priced based on the underlying security. The underlying security usually in this case will be the debt of 1 CR. So the underlying security can also be equity. So an example
Right.
here is, for example, a stock of Infosys is a stock of XYZ is suppose worth rupees 1000, for example, and you want to buy a stock of that 1000 rupees, and if it goes up, so it becomes 1050, then you
Okay.
want to sell it and book the profit. But if it goes to 950, you do not want to take the losses. So what you will do is that's what you want. You want to say is that sell at 1050 and cut loss at 950, for example. So you will write a call. You should have to buy a call, a put and a call for that stock. So you have to go and see how the put and calls are calculated. There is a implied volatility ratio and there is a completely heat transfer equation based formula of calls and puts, and based on that,
Heat transfer.
physics heat transfer based equation, because it's based on randomness. So if you
Acha.
read John C. Hull's
Very interesting.
if you read John C. Hull's options, futures, and derivatives, you would get the formula of option. It's called Black-Scholes option pricing model. That's how you price an option. So you can price a call, you can price a put, and that price is based on the implied volatility of the stock. That implied volatility is again a function of beta, for example. So all the past volatility of stock with respect to the market prices changes and things. So based on that, you will find the value of call, find the value of put, and then you buy a call and so if you want very narrow spread, you buy a call and put of 1000. So technically, if it goes below 1000, you can sell at 1000 and you are safe. If it goes above 1000, you can again buy at 1000. So call is an option to buy, and you will still be able to sell and make some money. If you buy a call of 1000 for suppose a particular stock and stock goes to 1050, you can say no, but I've already purchased the call of 1000, so you give me call at 1000. So suppose the price of that call is suppose 20 rupees. So and current market price is 1025, for example. So you have to pay 20 rupees for the call, and 1000 rupees is that the price at which you had written the call. So at 1020 rupees, you can buy a stock which is currently being traded at 1025. So then you immediately buy and immediately sell it. So you make 5 rupees out of thin air. This is what the benefit of having a call.
I see.
Similarly, there's something called as put. So put is something is that you want to sell something at a particular price. So suppose you have a put at say 1000 rupees, and the value of stock goes to 950. Suppose you have a suppose you have a security, you have purchased one stock and of XYZ company, and when you purchased it, it was at 1000. If you now go and today in market price is 950. So assuming zero brokerage, if you go and sell today, how much will you get?
950.
No. So if you have purchased a put of 1000, you can go and sell it at 1000 only.
Okay, okay.
So you will get 50 rupees extra. Even if everyone will have to sell it at 950, you can sell it at 1000. But that price of that put will also be something like 20-30 rupees or whatever will the price of the put. So you have to spend 30 rupees is the kind of insurance that you will always be able to sell your equity at that particular price. So if suppose the market value, the value of equity is 0 rupees or 1 rupee, so everyone is losing 999 rupees, you can still sell at 1000 rupees. So just by spending 20-30 rupees, you have purchased a peace of mind that whenever you want, you can sell it at 1000 rupees.
Okay, okay.
So that is called a put. So here, if you have written a loan of 1 CR, you want always to be able to have 1 CR of liquidity with you. You have to write similar options, and those options has to be purchased by someone. So the people who will purchase those options will know the underlying security. They will know that the underlying debt is issued to Apollo Tyres at this for doing this. So they know how Apollo Tyres is performing. So then they will price the market based on market implied volatility of the stock, based on the debt service coverage ratio. There are many things due to which they will price the puts and calls in such a way so that you can go and buy it. It's like when you buy a 1 crore insurance for your family, it comes in a TV, na? Monthly it is like 700 rupees. You can buy a 1 crore health insurance. In the same way, you are buying an insurance to sell underlying security. So security is a polite way of saying stock, bond, fixed deposit, rupee in your pocket, if you have 100 rupees note in your pocket, it is also called as security.
Hmm.
In America, there was a book written by Benjamin Graham called Security
Okay.
Analysis.
Hmm.
So, which has all the equity, debt, everything is called, anything which is traded in the market is called security and financial instrument. So that is the long and short of it. So now you got na what is call and what is put.
Yeah, I think I have a very rudimentary idea of what it is.
I'll
Maybe
cover it
I'll
in deep.
explore more, and maybe
Ha,
towards the next session I'll have more idea.
I'll do a deep dive on that. Don't worry. That's my favorite topic, and that's
Ah,
what
okay.
that's where exactly where all the quantitative trading and hedge fund traders go. So if you
Mm-hmm.
want to make like 2-3 crore salary per year, that's where Goldman Sachs and JP Morgan and Morgan Stanley and everything, they take the best of the best students, and that do something called as HFTA, hedge fund trading. So they have to write very unique kind of option, not the standard options. So
Mm-hmm.
there are many artificial options written.
I
Those
see.
those options are then used to price lot of securities in the market, securities, projects, and
Mm-hmm.
the role of these options is to do the risk management.
Mm-hmm.
Okay.
Perfect.
Sure, sir. So now you have added some buffer to your principal. Now tell us
Yes.
what else you have done on the sheet.
And one more recent change that I did, which I did not do last time,
Hmm.
was if you go to F5,
1 second, I'll make it a bit larger. F5. Okay.
F5.
Huh.
So earlier, what? Can you please click on the formula? I mean,
Okay.
can you please double click on the cell?
Huh. Huh.
Yeah. So what I did last time when we discussed was, in order to convert annual interest rate into monthly interest rate, I just divided it by 12,
Hmm.
which is nominal.
Hmm.
But that did not account for the present value of the interest rate.
Hmm.
Because instead of getting one payment every year, I'm getting 12 payments every month. Sorry,
Hmm.
12 payments every year.
Hmm.
And the fact that one payment is being made 1 month and the other payment is being made at month 12,
Hmm.
you're going to be discounted differently.
Hmm.
So if you could please go to again column number, column N and O, towards that one.
Column
N
and
and O.
huh.
Yeah, so I took the help of ChatGPT
Hmm.
to arrive at the formula. Let's
Hmm.
say, let's take the, let's just take 1 rupee.
Hmm.
Now 1 rupee is getting discounted at the rate of R% every year,
Hmm.
whereas the same 1 rupee is getting discounted at the rate of X% every month.
Hmm.
So the sum total is 1 rupee and it's getting discounted at 12.
Hmm.
So how do I derive monthly from yearly? Is I take 1 plus R and I take the 12th root of it and I subtract 1 from it.
Hmm.
So this is a addition that I've made.
Hmm.
And again, we're keeping the month of the months as 3 years.
Huh.
NPV is positive, but the target IRR of 14% is not really possible.
Acha.
I've even
This
made
is
a
which
little,
row?
pardon?
Which cell?
Just a second. So it is cell F70.
70.
Yeah, 70. F and G 70.
Okay. This is 1.82 and 2 lakh 21 lakh rupees.
Yes.
If we ignore the pound sign, we have to figure out how to get rid of this pound sign and get it as some other way. But ठीक है चलो अभी के लिए it's fine. Um, Understood.
Yes.
So
So,
you still have 2% kind of IRR and
mhm.
NPV is at least positive, which is positive sign.
Yes, yes, yes.
Hmm.
Um, but let's say I make the interest rate something ridiculously high, like 93%. If you can come to D5, you see that I've made it 93.
Hmm.
And again, the IRR is still 7.7%. We're not achieving 14% just yet.
IRR will not be that high. Na? Internal rate of return is different from what you are calculating there.
No, but again, the problem statement that you gave the other day was
Uh,
to achieve a target IRR of 14%.
Problem statement 14%.
Yeah, it must be there in the Google slides that you sent last week.
Google slide that I sent in the last 1 second.
Yeah, it must also be there in our WhatsApp chat because I asked you for a PDF.
Mm-hmm. 1 second. Web.whatsapp.com. Let
So
me.
just a second, I think someone's at the door.
Mm-hmm.
Yes. So if you could please scroll to the last slide.
Last slide. Okay.
Yeah.
14%. Then rebuild
Yeah.
PMT, recalculate IRR, add processing fee, recalculate IRR, then build PMT is 14% by 12, 14% per annum. Can you see this? Let me make it a bit larger.
No. Sorry. It's not there in the slide. It's there in Notion actually.
14%
I'm
divided
so
by
sorry.
12. So it has to be 14% to be honest. It cannot be more than that. If it is there, then there is a mistake there because that will be too high. 93% is ridiculously high. Then there must be a mistake. It is 14% per annum. That is something which is considered market beating. Anything above 10% is market beating, but on that it is less riskier, so the amount will be lower, but 93 will be too high because 93% means that you are literally writing a loan that doubles itself per annum.
Yeah. No. I just wanted to give like an edge case just to
Edge
see
case.
if IRR improves. Matlab, at the rate which is pretty consistent.
So yeah, so IRR is um, how do you define IRR? Tell me first. I know you are sharing that IRR should be high. So if suppose you say
So
that you are
IRR is the discount rate at which my NPV is zero. It is the NPV is break even basically. And neither the investment is neither making any gains nor making any losses.
huh. So that means when at the discount rate of 1.82%,
Mm-hmm.
your company is neither making any loss or any profit
Yeah.
in the project for one CR alone, right?
Yeah.
Right? Yeah. So this is because you have here taken interest rate of 14%, and what is the cost of capital?
Cost of capital is 7%
Acha, where have you
for
mentioned?
Bajaj Capital.
So have you included that in this formula?
Yes. It the cost of the cost of capital is at K L68. Sorry, L68.
Okay. Huh. And how does it impact the profitability? So like how is it? How are you reflect? It will not be appearing here in the IRR, but because you have this one CR on which you have to return 7%, and you are making 14%, then what is your net cash flow?
Could you please repeat the question again?
So this 1 CR, for example, bank takes a debt, Bajaj Capital takes a debt of 1 CR and then gives that 1 CR to Apollo,
Okay, okay.
right? So then Bajaj has to pay back 7% per annum to someone and get something from Apollo, and that has to be more than 7%. That's only when Bajaj Capital will survive. So you are saying,
It.
that Bajaj Capital writes a 1 CR loan at 14% to
Mm-hmm.
Apollo Tires,
Mm-hmm.
and but that 1 CR actually Bajaj Capital has got at 7%.
Yeah, yeah, yeah.
So then how do you include that cost of funds in the break even calculation?
Mm,
Had it been your money, had it been Bajaj Capital's money, then you just use the same formula of NPV and IRR. It's a money at which the opportunity cost is zero.
certainly.
Use
So,
large language model, and first use your own large language model in your brain, and then you verify it with a large language model. Let's see what the LLM
uh,
says, because the capital is not free. It's like borrowing to lend.
great. So, wouldn't my IRR in that case just be my implicit rate of borrowing?
Not necessarily. Not necessarily.
Okay. Mm, I wonder how the loan repayment structure for Bajaj Finance would be, because it really depends
Make
on
an
the.
assumption. Make an assumption, na? Make an
Sorry.
assumption. Make an
Okay.
assumption.
So let's just say Bajaj Finance, instead of issuing bonds or whatever, let's say it's just taken a basic loan. And
Make very simple. Keep it very simple. For example, Bajaj has taken 1 CR at 7%. That means Bajaj has to give 7 lakh rupees as interest every year.
yes, yes, yes.
And so Apollo Tires has to give Bajaj more than 7 lakhs per year. Then only Bajaj will make money, na? Very keep it very simple. Literally use pen and paper. That
Sure.
means if Apollo has to give Bajaj more than 7 lakh rupees per year, how much more than the 7 lakh Apollo has to give, so that the Bajaj makes a positive NPV on this project? Right? Very simple. So that means every year net 7 lakh has, or 700,000 has to be cash flow from Apollo to Bajaj just to service Bajaj's own debt, and then anything above that is what Bajaj makes, and Bajaj is carrying the risk of default. If Apollo defaults of on 1 CR, where will Bajaj get that money from? Because Bajaj has to repay back to from where they have borrowed.
Got it.
So then Bajaj will add a financial instrument like a call or a put, so that if Apollo defaults or Bajaj has to buy an insurance, that cost Bajaj will layer.
True, true, true,
Then you can also ask that why didn't Apollo take that money directly from that person? Why did Apollo take it from Bajaj?
true, true, true.
For example, yeah. Anyway, that example is good enough. It doesn't need further illustration, but that is should be the basis, and then you calculate. Okay, you keep it in your mind. This is an additional task for you. Let's start with today's debt equity and debt service coverage ratio, because we are almost halfway through. Chalo, batao, what did you do for today's session? Tell us.
For today's session,
Walk us
he
through
would
your
please go to
assumption.
S5 sheet number. Sorry.
Walk us through the assumption. I'm on Google Meet. I have shifted to the sheet number
Yeah,
S5.
yeah, yeah.
Huh.
Perfect. So the assumption is just this. In order to calculate debt to equity ratio, I need two things, which is total borrowings and total equity, the source of which is balance sheet.
Hmm.
So I've taken the number. If there's a calculation involved, if there's an addition or subtraction, I've mentioned what should be done
Hmm.
and the source, like from which data bank did I take it? Is it from the balance sheet, P&L, or cash flow,
Hmm.
either from operations or finance?
Hmm.
So debt to equity ratio for Apollo tires is 0.27, whereas if you look at JK tires, two segments down the line,
Hmm.
from 0.27, JK tires has the highest debt to equity ratio.
1 second, na? 1 second. Let me insert these here so that good work done. I'm just trying to ensure that it looks neat to everyone here.
Sure, sure.
Okay, just give me 1 second. Debt service coverage ratio, debt to equity. This is Apollo tires. This is Command C. Command Shift V. Next is, let's make it this one. Make this one also smaller. Then you have MRF tires. MRF tires, debt equity. Here, Command Shift V. Thank you. That they can see it. Go ahead. Just go ahead and paste it.
Yeah.
That will help me. Thank you so much. We have to do Control Shift V for a Windows laptop and Command Shift each. Otherwise, it will not copy. It will copy the formula. Otherwise, Hanji.
Yeah. So it's this basically.
Hmm.
And if we look at the debt equity ratio, then MRF tires uh, is the least levered. I'm not sure if least levered is a very good.
Least levered, na? Least levered is good. It doesn't have any
Okay.
debt.
But JK tires is 0.63, which is extremely high when you compare it to Apollo or MRF.
Acha. What
And
is the industry average?
industry average, I haven't calculated.
For the you have to just Google it up. This is not
Yeah,
something to
yeah, I'll do
calculate.
it right.
How much is the tire companies usually in debt of? Is it a capital intensive business? Is it a capital light business? Just like telecom companies are always in debt. Airtel, Vodafone, they are in huge debt.
Yes. So please come to column H.
column H. Okay. हाँ एक सेकंड. हाँ. So what I have done is I have put a chart here.
Okay.
So sorry, you were covering something else. H something.
So if you look at the debt to equity ratio of all these companies,
Hmm. So now I have to take a 2 minute break. Huh? One of my friend is joining
sure,
here. I
sure,
have to
sure, sure.
meet him. Can we do a quick 5 minute break and then we'll continue?
Sure, sure.
ठीक
No
है?
issues, no issues.
Sure. Just go on mute. Yes, I'm back. I'm so sorry. This went for a bit longer. Uh, are you there? Maybe there. Not
Yes,
there.
Mr. Singh, I'm here.
Acha, thank you. Thank you so much. Sorry for the interruption. It was
No problem.
someone who had not met me yesterday on my birthday. So that person was a bit grumpy. I was also a bit grumpy. He's my childhood friend. So I said that, why did you not meet me? And so I cut his call, and then he said, why did you cut my call? I said, I am live on my channel. He said, nay, can you come just have 2 minute chat? And so I got this. Let us see what is inside this. He said, I said, don't give me gifts and things. He said, no, you have to take a gift of birthday. I gave him some chocolate and stuff. He gave me, I'll open and see what's inside. Your video is off, huh, by the way. YouTubers can't see your face.
Is it still off? One
It's,
second,
yeah,
it
it's
says
showing green.
close other apps that won't be using your camera.
I think you are starting another app that uses camera.
No, I just restarted it.
Acha. Now, so he gave me this, and we took some photographs, and he said that, hey, this is your birthday, so I have to give it something. I said, he said, I came back home from work at 11:30 in the night. He told me at 6:30 that I am coming. I said, okay. I waited for 1 hour. He said, no, I'm coming from very far. Anyways, chalo. Sorry. Let's continue.
No problem, no problem.
You are at interest coverage ratio. Yes.
Yeah.
And I have plotted that for your comfort so that you can see that high in Apollo in blue, MRF in orange for those who are watching us on YouTube, JK in green, and CAT in blue. Chalo.
Yeah.
Tell us.
And if you could please go to column number H.
H, column number H. Okay.
Yeah, so I just got this screen cap from Screener.
Acha.
If we can see, so JK is one of the companies in the rubber segment with the highest debt equity ratio.
Highly
And
leveraged
if you
company.
see towards number 13, Goodyear tires is almost debt free. It's only 0.05.
But then you have to also see the market coverage. So if you launch a new phone, if you launch a new SIM company, for example, and you have only 100 customers, then you will have a with zero debt. Suppose you are launching a virtual SIM like a Matrix or something, then you will compare with Vodafone, which is under lakhs of crores of debt. So what is the market share of Goodyear? If they are a nobody, because we remember these four were the top 80%.
Yes.
So then if the market share is nothing, then it doesn't matter, na? So
Yes,
the
yes,
point
yes.
is, are most of the telecom company under stress? Yes. Why? Because they are not able to make money. Are most of the media company under stress? That means is Z5 under stress? Is Hotstar under stress? If you launch a very small media company, say that company is not under stress. That company does not reflect the media market. That's what I'm saying. Hotstar reflects media market, Sony reflects media market, Z5, Zio Cinema, the larger players of OTT, they represent the OTT media market. That's my intention of saying.
Okay, okay.
So, what is the market share of Goodyear in Indian tires?
Uh, Looking at it, just a second.
Let me also look market share of Goodyear tires in India. Less than 2%. ChatGPT.
Okay.
ChatGPT 2%, less than 2%. So they don't reflect the market. So what is the D? This is debt service coverage ratio, na?
No, this is debt to
Debt to
equity.
equity. The debt to equity can be individual choices also. No? Some company can choose to take a lot of debt. Whether need it or not, we don't know. You can take a huge amount of debt and spend it on marketing as well. For
Yes,
example,
yes,
if you
yes.
are an asset-light company, you don't need a lot of money. You can still take a lot of debt and do spend it on non-core tasks like marketing and all of those things, right? Industry development, vendor development, and whatever. So that's possible. What I did anyway, I'm still checking what is the DE for India, Indian rubber firms. Indian rubber, not Indian tire firms. Goodyear is debt free. It shows a conservative balance sheet. Nearly one for Apollo tires indicates more leverage. It's not extremely high. So the point is debt to equity. High debt has to be compared with the debt service coverage ratio. High debt is not bad if you are not able to service it. Then it's bad. Otherwise, the debt interest payments gives you interest tax shields. Those interest tax shields helps you reduce your tax liabilities. So debt is not always bad. Chalo, let's anyway continue. So you are saying something about the debt equity ratio. What I told was, just to summarize, is that Goodyear is not a bellwether of the market. Goodyear is not even a majority player. It's a 2% player. So the big four are JK, SEAT, MRF, and Apollo.
Okay.
And we have seen that if we go back couple of weeks, if we go back to revenue, which is the second from the beginning sheet, for those who have joined us recently. And if you go to column, if you can look at column number G, H, and I, then you will find that 30% market share of Apollo, 30% market share of MRF. So those are the two big players, Apollo and MRF. So the market share data becomes handy when we look at this. 30-30 for Apollo and MRF. So I'll mention 30 Apollo and MRF. Where is Apollo? Here. This is WAC. This is IRR. Let's go next. Where is that column gone? Here it is. Clicking your picture takes me to the right one. So here I think we are on this sheet, and Apollo and MRF are 30% market share, na? 30% market share. MRF is again 30% market share, and JK they are 15%. 10% 10%. Total is 80%. So 10% market share. This and this is 10% again. Chalo. This has good picture for us that 60% market shareholders both are same, but both have taken a different kind of a financial structure, financial choice. So Apollo has thrice as much debt compared to MRF with the same market share, but has a much, of course, that results in a poorer interest coverage ratio. Anyway, I'll let you go ahead and make some commentary about both.
Yeah. So, in coming to interest coverage ratio, since it is a bit upon financing cost,
Mm.
MRF is well balanced here. It is 9.3
Hmm.
compared to other players.
Hmm.
And I was asking GPT why this is the case and what is the optimal So GPT was saying anything above 3 is very good,
Huh.
apparently.
Hmm.
Uh, and I was wondering if MRF was somehow internally financed because their finance cost is very low.
Huh.
Also,
Apollo is a.
because the debt to equity is also very low.
Huh. Because Madras Rubber Foundation, they would have access to Indian rubber or Southeast Asian rubber raw material sources at a much cheaper prices. So look at where they are getting their rubber from. So they have been able to keep the cost of raw materials down. And Apollo, being a Swiss company, they may not have catchment areas where they can get cheaper raw material cost. So due to that, their debt to equity ratio anyway is higher, and the cost of capital is anyway not only cost of capital, the entire cost of operation is also higher. But other way looking at this, loans are much cheaper in Western world as compared to if you raise it from Indian markets. So, but we don't know how much of Apollo is, how much of the Apollo debt is priced in which condition. So, was Apollo in desperate times when it took some debt, so it was at a higher interest rate? We don't know the debt, the coupon rate for those for Apollo. But assuming that the coupon rates are kind of same, we find that MRF is very well poised to clear its interest payments, and they can service their debt better. Huh. And I think the debt they have taken is like 10% just for the interest tax shields and whatever. 91% is equity, so which shows that. And second thing is you can also see is what is the price to book value of the stock. So if they have this equity is book value, this equity is not market value, right? So whatever you see in balance sheet is book value. So its actual market cap is really much higher.
Yeah.
You got what I'm saying?
Yeah, yeah. I'm looking it up on screener right now just to see because the debt to equity ratio.
What is the
as per
market?
books are
What is the market rate of what is the market rate of Apollo tires currently?
the price at which it's trading or the market cap?
Today, if you wanted to buy it yesterday, what is the price of one stock of Apollo of MRF tires?
MRF.
Huh.
MRF is 1,40,985.
1,40,000 for one share.
That's what it says. I don't know.
MRF equity price. Finance.google.com.
Yeah, it is 1,40,000.
Oh my god, it's very expensive. MRF. Well, it's not expensive per se. It's just that it's takes a lot of money to buy one stock. Oh my god, you are right. 1.4 lakh rupees for one stock. Okay.
So the choice I have over the number of shares I issue, and consequently the price of the share.
It's mentioned here, na, here.
I
See,
definitely have an sorry.
so it's mentioned here on this. If you see on the screen, number of stock issued is it's not this. How do I get the details of this?
Market cap by stock.
It will be somewhere here, na.
I think market cap is above.
Where? This
Yeah,
one,
yeah.
listen, but yeah, so market cap by price, what they should have mentioned how much share they have anyway. 597 billion, 10 to the power 9. It is 6 into 10 to the power 11. Right? So this is what? A lot of mathematics, okay.
No, no,
6 into
1.4
1, it is, this is 10 to the power 1.4 10 to the power 5. This is 6 into 10 to the power 11. So 1.4 is 5 times, 5 times, and then 5 and 11, 5 lakh, 500 to the power 6. So they have put 50 lakh shares in the market.
Yeah, close to 42 lakhs.
42 lakh stock in the market.
Yeah.
Okay. Okay. And what is their book value of stock, MRF?
Just a second, looking it up on screen.
Hmm. What about 1,000? Approximately 45,000. What is it doing? It is C2 to G5, not G7, G5. Okay. So price to book value is 3x. So, so when you calculate this debt to equity, this equity is book value, na?
Yeah, this equity is book value from balance sheet directly.
Huh. But the actual value of equity is much higher. So that makes the equity much expensive. Now you have to give dividend. Of course, the dividend you declare it on book value, but compared to market value, you are giving a very small dividend. So at 45,000, even if you give say 10% dividend, it will be 4,500 rupees. It will immediately become whatever one third. It will become 3% dividend. Net return on investment if someone buys a stock, for example, right? So it's cheaper for them to have raise float more stock and increase their float and have secondary allotment of share in the market. And how much is the ownership with themselves? Is it like completely diluted or
As per the book or as per market, I think that does make a difference.
ownership is a percentage, like is MRF 50% privately owned and 50% they opened it to the market, or have they 20% of the stocks are owned by promoter? So the point is the
So
promoter.
promoters own 27%. Then public and retail, no sorry, public and institutional for around 41%.
Acha, public own 41%, which is the this which is 41% is this, right? Which is the equity, shareholder equity. It actually also has shareholder equity is this plus this also, no? How much is promoter equity?
Promoter equity is 27%.
It is this plus this. This
Let's
is
keep it 28, Mr. Singh. It's 27.7.
27.7.
Yeah.
28. Chalo, ठीक है, 28 we'll keep it. Is equal to 41 plus 28. That much is 41 plus 28. Oh, okay, I forgot to put an equal to. So it is around 70%.
Yeah.
Oh, तो ठीक है ना. Only 10% is debt. What about rest? It should be 90%, na? If 90%, I want the breakup of the 90% equity. 91% is equity. Sort of 91% of equity. How much of that equity is held by
Yeah,
promoter?
so just a second. Promoters 28, retail investors 41.5, foreign institutional investors 18.18, and mutual funds 8.04.
8.04. Okay. Let's add them up together. Yeah, it's 95%. ठीक है. Fair enough. So promoters still have around quarter of the stock. So if the company needs some money, or if they want to raise some more money, then they can do some kind of market linked activities instead of raising any money. They don't need money if they. That's the reason they have low debt. Have they planned any capital expansion in the near past, in the near future?
That also I'll check it out.
Mm-hmm.
4,000 crore over 3 years, ending at around 2027.
Hmm.
This is aimed especially for commercial vehicles and EV tires.
And they are planning to fund it through debt, or they are trying to fund it through their own cash reserve. How big is the cash reserve? So is 4,000 crore a big amount, small amount, negligible amount?
Total reserves is 18,000 crores.
Then it is a very small amount, no? It's literally 25% of the total reserve. Reserves in CR, and capital investment plan is 4,000. They can choose to go out in the market, but they can choose to also keep, because the cost of reserve fund is what they can do with it. If they reinvest that into business, and that will help them. See, high retention ratio and high return on equity leads to high growth rate. It will help them grow faster if they use retained earning to grow. So I think they will choose to have high retention ratio and high return on equity. And return on equity will come high when they focus on profitability, and they do not uh, intend on increasing the equity base. So G is RR into ROE, retention ratio into return on equity. That is the growth rate of any company. G is
Retention
equal to
ratio.
RR into ROE.
Okay.
So retention ratio is how much they keep. So if they have 100 rupees of free cash flow, not in free cash flow, 100 rupees of total earnings after they have given profit after tax, you can say, if it's but do not have huge depreciation and amortization. We can take EBITDA if it's not too high DNA. Then whatever is you give away as dividend. Suppose you give away 10% as dividend, so retention ratio will be 0.9. So if you have 100 crore at the end of the year, you give away 10 crore as dividend. And suppose you mentioned they have 50 lakh shares, right? So if they give 10 rupees per share, they have to pay how much? 50 lakh into 10 is 500 lakhs. 5 crore rupees dividend. Your video is gone again.
Okay.
It's completely black now.
Now is it visible?
Uh, it's green color now. I think you are shifting. 1 second. Did you?
Oh, this randomly blocks my camera. I just
It's completely black. Anyways, chalo, we'll continue. If you want, you can refresh and join back so that your face uh, stays visible.
Sure. This disconnecting and reconnecting.
Hmm.
Yeah, I hope now it's visible.
Yes, now it is visible.
Got it.
Now it is visible. So that is why if they're planning to grow faster, they would use this retention ratio and return. So retained earnings, and they will use that to uh, work in a very efficient manner. So that return on equity is what EBIT into 1 minus T by. So the EBIT has to be higher, and whatever they earn, they give very little back to shareholder. They plow it back to business. That the retention ratio is high, and they use that to invest into the company, and then that's how they grow. Next is we look at our main subject, which is their brother at 30%, but is now struggling. The debt service coverage ratio is 1 only, and we have already seen that Apollo Tyres has huge inventory. So they have to get rid of the inventory, and they are good in terms of interest coverage ratio with 3.63. Explain what is 3.63 and 1.13 in layman terms. What does that mean for Apollo?
Sure. So I'll just give it a try.
Hmm.
So interest coverage ratio is my ability to service my interest only through my operations.
Hmm.
So what I'll do is I'll compare my EBIT with my cost of financing that debt, and that'll give me my interest coverage ratio.
Hmm.
So for Apollo, the EBIT is 3.63x of the interest that it's paid.
Hmm.
Similarly, if we look at debt service coverage ratio, what we do is we take the operating cash flow
Hmm.
and we again divide it by the interest and principal.
Hmm.
Whatever has to be repaid and whatever interest they've accrued over the year.
Hmm.
So this again amounts to around 1.13.
Acha.
Yeah.
So, so if we summarize this, so if you are the banker to one of these, so peer comparison of Apollo and MRF, who would you lend to? So that means how much debt is for every 1 rupee of equity. So if it is less than 0.5x, which is zero point 0.5 rupees of equity, it is preferred for leasing because then they can make their lease payments on time. If it is more than 3x, which is interest coverage ratio, it is good for manufacturing. Interest coverage ratio is EBIT plus finance cost. EBIT divided by finance cost, right? So that means can they pay their interest? How many months of interest they can pay? EBIT is annual, so that means from annual income, how many years of interest they can pay? How many times the interest they can pay? It's just the finance cost. It's not the
Yeah.
principal. And then debt is principal plus interest, and the entire operating cash flow. So
Yeah.
companies can be cash flow negative and still have very high EBIT. How can companies be cash flow negative and EBIT positive?
EBIT positive, maybe no depreciation gets reduced no in accounting profit. So
Depreciation gets added. Depreciation is a non-cash expense. So in
yeah,
cash flow,
in cash flow it gets added
so how can you have
because
negative
once
cash
you
flow?
sorry.
So how can you have a negative cash flow for a positively company that has a positive EBIT? It's because if you have a
Reverse being true, company has positive cash flow, but due to high depreciation, you have to take the
no,
EBIT
no,
side.
not necessarily. Can also be that company has profit but negative cash flow. It's because the company makes profit, but company invests more than that much money in
Maybe
the. It's,
other streams of income that is not
no,
tied to
no, no, no,
operational income is very high,
no,
so
no, no,
EBIT
no,
is
no,
positive.
no, no, no. So that happens when the company has a huge capital work in progress or has a very variable working capital, because the two factors that impact the cash flow are change in working capital and the capital investment that they are making. If there any work in progress, so suppose you make 1 lakh rupees a month, and but you suddenly have a 1 crore rupees worth of capital investment happening. Suppose you start building a home for yourself in for 10 crore rupees, but your monthly income is only 1 lakh rupees. So in the short term, suppose for making that, the contractor says we have to put some sand, so you have to pay 75,000 rupees for sand. Now you have you will be cash flow negative in that month. You will figure out how to give that 75,000 rupees from somewhere to from that reserve to that contractor. Where the home construction keeps on happening while you live in Mumbai and work, for example, because you have taken a huge capital, and that's a capital investment. That's not a revenue investment. Whatever you eat and pay and rent and electricity bill and internet costs and mobile recharge, that's all the revenue expenditure. Capital expenditure, if the working capital change in working capital is very high, that can make your cash flow go negative. So what is change in working capital? You will figure it out.
Capital is current assets minus current liabilities.
That is working capital. What is change? If current liabilities are larger than current assets, that can happen. So then companies can choose to have a negative cash flow for a very long time. If they are not trying to bid for government projects and whatever, then they can choose to have a negative. So then the debt service coverage ratio can be low. But that's a huge risk for banks. For good for company because they don't have to pay taxes. Because if you pay finance cost, if you pay interest, you get 1 crore loan. If you pay tax to government of India, you get nothing. So nobody wants to pay taxes, right? So everyone wants to pay debt payments. That's where lease comes into picture. It reduces the tax liability and it changes the way their debt is structured. Okay? So next is debt equity ratio. In debt equity ratio, what we take a look is the total borrowing divided by shareholder equity, which we have already done. If it is around 1, it is very aggressive, but equity cushion is thin. If assets fall in value on which the debt is taken, is there enough equity to absorb the loss? That is something a leasing company has to look into before lending to company which has very high debt, right? So or there's also a place where a leasing company.
Just 1 second, Mr.
हाँ हाँ,
Please answer the door. I'm so sorry.
no problem. Yes. So you got the idea, right?
Yeah.
That when you have the assets on which that debt is given, that debt is written, if those assets get impaired, then that will impact the long term viability of the debt. So if you are using that debt to create an asset, and if that asset is not insured properly, is not covered properly, if the asset impairment is not covered, then you are in deep trouble. If you take debt to buy a car and you use that car to become a cab driver, and if you have that make daily earnings and you pay back to Ola, if the car gets damaged, how will you make earning every day?
True. And I think in one of the previous sessions, we also talked about asset utilization and how it comes in.
That is all second part. That's also that if assets fall in value, that's why that if you have low debt, and that's the reason Ola should not give the car to drivers who do not have any money. So if Ola wants to give a Swift Desire in Mumbai, you have all Swift Desires and Kali Pili. The Swift Desire cost is suppose uh, 12 lakh rupees, 13 lakh rupees, for example. It's not 12 lakh, but example. So they should say give 6 lakhs rupees from your own pocket, so that the 6 lakhs rupees lease payments are lower, right? That's the debt equity ratio. Interest coverage ratio is danger zone. Less than 2x is danger zone because one bad quarter, 3 months of bad, then that's crisis. More than three.
Mr. Singh, can we just go back to debt to equity ratio? I'm not sure if I understand. The lender asks for a part. If the assets fall in value, is there enough equity to absorb the loss before we get hurt?
Acha, you want to acha, on the same. Acha, acha, okay. हाँ हाँ.
Okay. So, not very, I'm not able to comprehend it intuitively. Let's say, for example, I'm a cab driver. I drive a Kalipi.
Hmm.
A fall in asset value can happen either due to damages or through regular wear and tear.
Hmm.
Just
I do have a hard stop at 10:56. Huh? I have a second class starting at 11. So I had to need to have
okay.
2-3 minutes of breathing space so that I can have some water, and then I'll start at 11. But I still have 3 minutes. So here, asset fall in value is not. So what you are thinking is, suppose you have a Kali Pili. Suppose you have a brand new Maruti car, and if it is completely, you have quickly paid then the debt, and the car is completely brand new, you are using it, and the asset value is high, and you are happy. But that's not happen in real world. In real world, if you make payments on time, if assets fall in value, it's because the asset has become old.
Yeah.
If the asset has become old, that means you need to have enough money in your pocket to make repairs, to ensure that if you buy a new asset, if you do not get enough money to, or if the asset is impairing faster than the debt payments. For example, if you have taken a 10-year loan to buy a car, and in only 3 years your car has completely gone bonkers, then how will you run it for next 7 years? Because you have to keep it running for 7 years to pay back the entire loan, right? Otherwise, before the loan is over, the car itself is gone. You have to buy a second car. So technically, your car should be there after your loan is paid. The car should make some positive value for you,
Sure.
right? So if the life of vehicle should be more than the life of asset, should be more than the life of the debt. If life of asset is lower than the tenure of debt, doesn't make sense.
Yeah, yeah.
That is meant by assets fall in value. So whatever assets that have been funded by taking debt, their effective life should be more than, or their healthy life, or their remaining life should be more than at least the tenure of the debt. That then the benefit of ownership comes into picture. Else the leasing comes into picture, because you never own the asset. If suppose XYZ leasing company sends a salesman like Prashant to go and sell an asset on lease, then doesn't matter. If assets fall in value, the lease payments fall. It is a good thing. Here it assumes ownership, right?
Fair.
If there is no ownership, then it is good. Assets, because if the lease payments are linked to asset value, then as the asset value falls, the lease payments also fall.
Right.
But then you would have to also ensure that the impairment is done linearly. If I take an asset from Prashant Leasing Company and I damage it on a day one and say the value has gone down, so I'll pay you less money, you'll say, you took a 10 lakh rupees worth of thing, you damage it, now you're saying it's only 1 lakh rupees, I'll pay only 1000 rupees. That's not how it works. We need to have some covenants to cover the asset impairment also, no? Anyway, so we'll continue this in the next class, because I have only 2-3 minutes. I just want to flash couple of slides. There are 8 slides. I'll flash them fast. You can cover them later. Folks on YouTube can have a look. This is what each actually measures. Interest tells you whether the operating profit comfortably covers the interest. It ignores the principal, pure interest. Debt service is the most important ratio for a lessor. That means it includes the principal, how much cash someone has, and how much cash is owed to lenders. That's our debt service ratio. The pre-class work was calculating this. Students usually take total borrowings, long term debt. It should also have the short term debt as well. So, long term debt, current plus non current both debt, that's required, so that if the company goes bankrupt today but not bankrupt in the long run, that should not be the scenario. So, they should be comfortable currently to operate, and they should have sufficient money in the hand for the working capital. So they should not spend all the money that they have that they earn every year on repaying the debt. Then the working capital, if suppose they need sudden infusion of equity, they'll have to take again fresh loans. So working capital should be there. That's where the loan lease is better than loan. Then is don't use PAT and PBT in the numerator because they include tax effect and they decrease the logic. So instead, we should back calculate a bit and add the finance cost back in the ICR. Next is don't use EBITDA as a proxy for OCF because EBITDA includes the ignores the working capital. A receivable heavy company can show EBITDA profit but no operating cash because they have to issue. You have seen that they have put away a lot of money to the as advances to their team, to their not the, to their vendors, to their agencies across India. Total debt, total equity, prime led, as you know, the biggest irony is that the people lend to those who don't need the money. So MRF is the one who is the prime for receiving money, but they don't need the money. Okay, it's already 11 o'clock. I have to leave. See you. Take care. Bye bye. Okay, do the deep dive and other things when you have some time.
Sure, Mr.
The prime borrow is MRF tires. The others are a bit struggling. I'll stop.